Now, next up, I'd like to welcome Felix Fernandez from 21E6 Capital, Maximilian Bruckner as well, if he still likes to, and Christian Viehhof from the ITSA. He's been on stage already.
Yeah, so welcome to the afternoon session. I would like to guide you through what we have developed in the last months from 21E6. We call it Next Generation Crypto Sector Indices. Give you a little bit of background about rationale and also show the first results and maybe opening a new chapter in the dimension of investing in crypto. So we're putting, let's say, our investor hat on. Important disclaimer, this is no investment advice, so please reconcile with your private investment advisor or your bank before you do any investment decisions. So this is just for education. Quickly on the team, so 21E6. In the meantime, since January this year, active as investment advisor, advising investment professionals with solutions like funds, indices, and structured products. So the case for crypto indices. So why do we talk about that? So, I mean, first we have to accept, and we can learn these lessons from the equity market. The market is very hard to beat. Yeah? So if you look at, there are sufficient statistics around, but you look at the SPIVA index from S&P, they're publishing this every year, and they're showing that only a very small percentage, and we're talking about roughly a one-digit figure, are capable of outperforming the market. And when we look deeper into it, probably most of them by just taking higher risks. So we can assume that this mechanism will hold for crypto as well. Basically, it's the benefit of diversification, but it's also the benefit of typically looking at the most relevant market players, so market cap is important. Also new investors, the topic is entry barriers. So what we're seeing is that nowadays roughly 95% of volumes in crypto structured products, so ETPs for example, are held within single crypto trackers, which is not a very efficient way of investing. It's like you would buy just one stock or two or three, and that's it. And typically you would think about it and say, well, yeah, I have a high concentration risk, and that's true, and it's also true for crypto as well. So the crypto market is much deeper and much larger than many people acknowledge. The problem is a little bit of distortion that we will discuss in a minute. But our hypothesis is that a managed index is probably the most efficient way and the easiest way to invest into the market. And last but not least, it is interesting for all investors. So it's not retail only, it's also institutional because it adds value to exposure when you have, let's say, ideally a packaged exposure, which means a diversified portfolio, a diversified basket into an asset class. So when we developed these indices, we looked at what are the challenges today. And the current challenges are many of the existing baskets or indices have a limited market representation. And when you look into the weights and you see that you have around about 90% of the index consists of Bitcoin and Ether, effectively you are having an extremely high concentration risk. So these indices are typically constructed from the perspective of the equity world, where market capitalization is a very good format, but with crypto there are some caveats due to the high concentration, so you have to soften this. Also, due to this high concentration, the diversification effects are basically none. So if you can just, most of these indices which are existing at the moment and where some ETPs around can easily be replicated by just having a 50-50 portfolio of Bitcoin and Ether, and that's it. But you can do better than that. We can show that there is potential behind it. And also, you have some issues with outliers. The crypto market is quite fast in its development, so you see then some spikes where crypto tokens jump in market capitalization, jump into a higher degree, onto a higher level, and then fall back again relatively quickly. So you have to also consider these fast movements. If you do this, if you look at the equity world, you're typically not having these moves in the large players or in a relevant form. So what we wanted to solve here is to have a structured approach into looking into a market. So we're building a market classification which allows you, if you want to have an explainable way of why you are building the baskets that you want to build. Second, look at this, let's say, capital weight trap. Yeah, or you have to build in, as I mentioned, this is an issue. You have to build in some weighting corrections without diluting it too strongly. And this outlier resistance. So you have to deal with that. You have to manage the way that you're keeping your index stable. Why? Because an index is only valuable if you track it. So if you make it investable. I mean, otherwise it's a benchmark, that's nice, but to really make use of it, you need to invest into it. What I also wanted to communicate today is the official cooperation, our partnership with ITSA, and our partnership with Open Metrics Solutions, a spin-off from ETH Zurich. Starting with ITSA, what drove us here was that ITSA developed a state-of-the-art framework to classify crypto tokens. And it already covers quite a large universe. I mean, the universe per se is much larger, but already the classification logic is very stringent and very clear, and it already covers a significant proportion of the market. And also, it's already a standard, or becoming a standard in the market, with also sending these classifications to, for example, VM Datenservice, which is a renowned data provider, as you know, in the exchange business. On the other side, we need the, let's say, know-how on the side of how to construct the index and how to manage the topics, and this is where Open Metrics comes in as a provider, a technology provider in Switzerland. Now, we came to question us, okay, if you look at this classification logic, and you can open the ITSA website and you will see, or you can download documentation where you see a large bunch of classification, which is, let's say, very complex at the first sight, but we tried to boil it down, and we came out with these 6 indices starting from the dimensions. So if you want, the dimensions are the overarching principles. So economic purpose, technological setup, what is the consensus mechanism, the issuer industry, and the type of maximum supply. And I would like to take out 2 which are quite new in this perspective. With this results into classification. And when you look at this classification part, basically for each of these classifications, we developed an index. And when you look at, for example, X proof of work means basically proof of stake, which is kind of an ESG perspective on crypto, which is relatively new. At the bottom, fixed supply is basically looking at, do you have a non-inflationary, let's say, dimension in this topic? So we try to find technology and, if you want, economic dimensions to say, okay, this is a way to look into this universe in a different fashion. Now, very briefly, you see here the overview. On the bottom, the top 10 components. The component list can be rather large. So you see here that the number of components ranks from 200 plus to roughly 50, and the according market cap dimension. So you see that you're basically looking into different dimensions, not only from the number of tokens, but also from the market cap perspective. And when you now build or construct an index, and this is what I would like to allude then, is basically you build on this classification. I would say there's one caveat, and you will see this in the results, and this is the overlapping nature of these tokens. Yeah? So for example, you have Ether in the first 3, for example, or in the 5th index. So what happens is with this kind of overlap, you have a market representation. So I think it's a correct market representation, but it has also some co-movements which we can show. I mean, I also have to say, this is just step 1. Yeah? So we said, okay, we start on a level where we look into these indices, looking forward, and this is, of course, let's say, room for further research, is to, if you want, dive deeper into this universe and find maybe additional segments which show then different properties. But what we want to show here is the first step, so the first proposal of launching such a concept. Now, this is just to give you a visual impression how this behaves. I mean, we have done here a backtesting, which depends, of course, on the availability of the tokens. An important message here is always to look at the black line. This is Bitcoin. And then you see here the 6 indices, how they behave. And you see, for example, an interesting effect is that there are 2 clusters which emerge, and where you see that they seem to move very similar, and in a sense they also do, but they decouple from Bitcoin. So you see a universe which shows own dynamics. And this is basically, or this confirms our hypothesis that by getting into, or let's say getting access to these dynamics, you can have a different view on the market and not necessarily on just a typical index construction. Another perspective is when you look at the risk-return distribution. You see that you see a Bitcoin somewhere in the middle. So this is annualized return and volatility. Very typical view on getting an idea how you how you are getting compensated. So how your relation between return and risk expose. And you see here also the 2 clusters, how they emerge. And so they show much higher returns than Bitcoin, but also higher volatility. So you have higher dynamics and higher risk in there. But the Sharpe ratios are partially even higher. So your compensation is even better. And you see that this is the shaded part over sector EVP. That means that's the equally weighted portfolio of these 6 indices shows already that you're getting a very good risk compensation and shows a higher market dynamic than with Bitcoin alone. Now looking at the dark side, drawdowns. Yeah? So many people are, let's say, frustrated by the drawdowns you observe in the crypto universe, and this is a different topic. You have to deal with, let's say, appropriate deleveraging and so forth. But what it shows is 2 things. First, the decoupling also in terms of, let's say, having different market dynamics. Higher volatility typically correlates highly with higher drawdowns. So this is basically confirmed here by this chart. But what is interesting is that in phases where you're talking about market crisis situation, interesting, they are converging. Yeah? So you see the market dynamic as a whole, how it moves. And this is a very typical effect that you can also observe in other areas. Also here, don't be scared with the numbers. It's more about the visuals here. So if you look at this vertical column, it shows that there is less correlation between Bitcoin and the sectors. So this basically confirms that there are other market dynamics going on in these sectors. Interesting-wise, the correlation within the sectors is relatively high. So also here, this is, let's say, still a new field we are looking at, a new industry which is emerging, and typically, let's say, market convergence or market dynamics go hand in hand, and looking forward, maybe we will see a decoupling or a stronger decoupling from each other, and maybe also looking further into other, let's say, cuts into this market or crypto market. Correlation, looking at static correlation can be sometimes misleading, so it's always important to look also at the rolling correlation. You see here the rolling correlation moves between 0.5 and 1. The interesting thing here is, again, during market crisis, correlation increases. So this is not only valid for traditional asset classes, it's also valid for crypto, obviously. Don't be scared by that one. It's, I just wanted to look over the fence. So when you see, yeah, okay, but it looks very similar, so where's the benefit? I mean, here we are looking, this is from the Swiss Performance Index, so these are the different technology sectors in the Swiss Equity Index. And the interesting thing is that, yes, you see much, let's say, broader distribution of the rolling correlation, but the 2 effects are interesting. First, when a crisis comes, correlation increases. Yeah? So you see here this middle field, from basically a very short time period, almost all sectors, equity sectors, and I mean they have a long history, so it's already a well-developed perspective in the industry, in the equity industry, to work with sectors is very common for many, many years. And you see there how they jump and how they become quite tightly correlated. Yeah? So correlation is a dynamic thing, and it guides us into the direction that we should live with these effects, but also think about potential benefits that can be provided. What can we conclude from that? So we can see that we have different segment dynamics, but also in a certain sense we see some similarities. So the co-moves during market crisis are relatively high, and they're still overall quite highly correlated. But we are convinced that each of these sectors has the potential to create unique segment dynamics. Second, maybe by looking or dissecting these sectors a little bit more, so maybe eliminating some kind of overlap between the sectors could provide even additional insight. Again, we are just at the beginning of this journey. What we also can see, and this is quite interesting, is the decoupling from Bitcoin. Yeah, so if you just looked at the market and just being driven by Bitcoin, you are missing a lot of market dynamic. Coming back to the topic of concentrated portfolios, if you just buy a basket where you have 60 or 70% Bitcoin in there, there is not so much of diversification. Yeah, so thinking about the potential, and this is what we try to convey here, there is huge potential below the waterline. The question is how to approach it. And what we want to show here is that having a more structured approach, so not just purely market cap driven, nor just driven by any more or less casual selection processes or custom selection processes which are not transparent. What we propose here is to come with a well-structured approach and gaining and learning the lessons from the market dynamics beyond that or derived from that. Yeah, so coming to what's next. We have basically finished our first step, which is creating these 6 indices at the first, if you want, basis. So we are now capable of calculating these indices and have basically done our homework of modeling these and let's say assessing it. Phase 2, this is basically consists of basically the most important thing is basically calculation and publication of an index. An index is only valuable if you can publish it. And the last phase, of course, this is important, then launch index trackers. Why? Because an investable index is what creates the value, so that an investor can use it and can track the index easily, because typically investors don't want to do this by themselves. It's a very common behavior to just buy the market in one package. And then I'm finished, and I don't think I'm surpassed too much, so I think I'm more or less in time. Okay, then yeah, thank you very much. I hope I could give you some insights, and I don't know if you have time for questions, but yeah, thank you.